In this section, we're going to continue discussing about the unit second of financial management, and specifically around the concept of returns on fixed income securities and how do we arrive at the value of a fixed income security. We're going to borrow heavily from what we have already learned in the net present value concepts and finding the present value of a particular set of cash flows. And that concept is going to get implemented in details around this entire understanding of valuation of fixed income securities, right? To understand this valuation of fixed income securities, let us first arrive at a basic understanding. What is the concept of a return on a fixed income security, right? So when we talk about returns, it is important for us to understand how much returns can be made on a fixed income security and how do we actually calculate that. Once we zero down on this, then it becomes easier for us to actually replicate this and use this in the pricing of a fixed income security as we go along, right? So let's understand the beginning of return or yield. Yield is essentially nothing but what we're going to call as the returns that someone can make on a bond. Let's understand the concept of yield on a bond, right? Assume that an issuer comes to issue a bond with a tenure 1 year and an interest rate of 8%. This means that for every rupees 100 raised, the payout at the end of the year would be 108. Right? So you've invested rupees 100 in year 0, and at the end of year 1, you're going to get 108. So what is the return on this instrument? Can we find the return? The return is essentially 108 minus 100. That's 8 rupees that you made on an initial investment of 100. That's going to be equal to 8%, right? So that's the yield on this instrument as it stands now. Now suppose the price at which the bond is bought by the first investor is different. It's not 100. It is either higher than 100 or lesser than 100. How does the return change in that case, right? So let's try and use an Excel file and try and understand this there. So this is the example we are looking at, and what we are saying is that the return, if we calculate here based on the formula, was 108 minus 100 divided by 100. That's the return, correct? And in other words, we could kind of say that this is 8 by 100 is the return that we're looking at, right? Let's calculate the return here. If this was bought at the correct price, that's 108 minus 100 divided by 100. And let's convert it to percentages. That's 8%, right? Now let's assume for a minute that this company came to issue this bond at 100 rupees with an 8% interest rate, but the market did not buy it. So they came and did the auction at 100, but no one bid at 100. Now what will happen in the market? In a general market, if you're trying to sell something for 100 and no one is willing to buy it, you'll reduce the price. So you reduce price to 99 and let's say it gets sold at 99. Now what is the return? Can we find out the return? Essentially, you're paying 99 here instead of 100. What happens to the return? That becomes 9.1%. Why? Is because now the return calculation will be 108 minus 99 on 99. On your initial investment of 99 rupees, you have made 9 rupees. Why? Is because 108 is fixed. Why is it fixed? Is because the face value is rupees 100 and the coupon is 8%, and both of these are fixed. That's why it is called a fixed income security, right? Because your end outflow is fixed. If you pay lesser, if you pay 99, then you're going to make a bigger return because you're going to make 108 on 99 now. If you paid 98, the return would be even higher, right? So if you paid 98, the return would be 10.2%. So the lesser you pay for the bond, the bigger the return keeps becoming. On the contrary, let's say you came and bid at 100 rupees and someone came and bid, you came and opened the auction at 100 rupees and someone came and bid at 101. They were willing to buy it at 101, which means the return was 6.9%. Now, someone will only buy it at 101 if they are happy with a return of 6.9%. So essentially, the price is defining the return. And one thing that is very clear is that the yield or the return that you are making on this yield or return that you are making on this is inversely proportional to the price that someone is paying. Higher the price, high price will mean low yield, and low price will mean high yield. Correct? So that's the first understanding that we get. We are trying to essentially understand what is the return on a particular bond or a yield on a particular bond, also commonly known as the same premise of yield is also known as YTM. What does YTM mean? That's yield to maturity. Remember, this return of 6.9% is only going to come if you hold it to the maturity of the bond. That's when 108 comes to you. If you sell in between, the price could be different. We don't know what that price is, right? So that's an important premise. 2 or 3 points that we have understood here is one, the higher you pay initially, the lower your return would be. The lower you pay, the higher your return would be. Two, your return is only fixed at this number if you hold it to the final cash flow date. If you sell it in between, the price you sell could be completely different. You might sell it at 106, you might sell it at 105, right? So effectively, that's the return is defined as yield to maturity because you're going to hold it to the end of the period. So, right? So when we say yield, it's also commonly referred to as YTM, and I'll again write it. YTM is nothing but yield to maturity. In simple words, what is the return that you're going to make on the bond if you hold it to maturity, right? Let's take another example. Assume a bond gives 121 after 2 years and nothing in between. What is the return? So now you're saying in year 0, you pay 100. In year 1, there is nothing. In year 2, there is 121 payment, right? Now, theoretically speaking, you would realize this number is going to be about 10%, is because if you invest 100 rupees today at 10%, then after 2 years,